Doji candlestick have the same opening and closing price, so its real body appears as a horizontal line. It represents indecision in the market. Let's take a look what's going on when a doji forms. As session started, price was driven up by buyers, but it could have also been sellers driving the price down. Then, sellers pushed the price back to its opening price, and even lower, just to meet the buyers jumping in the market again, and driving the price up to its open once more. This process could have repeated itself over and over till the end of the session, where the price closed the same as it opened. As you can see, there is no real conviction about which direction the price should go, and that makes this candlestick signal neutral. I never trade doji on its own, however it's nonetheless important as it helps you to draw support and resistance levels. Take a look. When a doji first appears in a rising market, I draw a horizontal resistance line at the top of the doji's high. For the market continuation, it now needs to close above this level. Next couple of sessions confirm that this really is a legit resistance. Just look, the price has tried to break through this level for several times. However, bears have always proved to be stronger and push the price back below as the session ends. So, if I'm looking for a breakout, I will wait for the price to close above this level before going long. And indeed, the next session price finally closes above the doji's high, so we can buy the market here. But now the difficult part. We have to determine where to put our stop loss order. As I said in our previous lessons, when setting stop we have to ask ourselves a question. What is the price that tells me I was wrong? In this situation, we are wrong about the breakout if the price closes back below the doji's high. How come? Because if it falls back below the doji's high, it means it has been just another false breakout. But we can't just put the stop order at the resistance level, because of the principle that old resistance becomes new support. So I would put my stop here just below the previous swing low. When price has tested this level as the new support, we can raise our stop to just below the test candle's low to lower your risk. Alright, this works with horizontal support and resistance. Now let's have a look at trend lines. A doji has formed at falling trendline resistance. As I have said before, a doji is an indecision candlestick and it can go either way from here. If I am looking for a bounce lower, I am doing the same thing as in previous example. I can draw a support line at the doji's low and wait till the price is closed below this level before going short. I put my stop couple of pips above the doji's high. So what if I'm waiting for a break? Take a look. Would you buy now as the price is broken above the doji's high? Let me tell you that I wouldn't. Remember what we learned about the downtrend. It is defined by lower highs and lower lows, and by the definition this is still a downtrend. At this point I would start thinking about closing my existing short positions, but I would definitely not go long. To start looking for any buying opportunities, the price first needs to make a higher high. So I would only be thinking about buying when the price is broken this level here. A lot of traders are losing money because they are trying to pick market tops and bottoms, but you know what they say, better safe than sorry. A long leg doji is a doji with the long wicks on both sides. If you ever see a candle like that, you know you don't want to be trading this market. It shows that market has been volatile enough to break on either side, but it has been so undecisive that it is impossible to guess the direction the next move will be.